Thank you, everyone. Thank you all so much for being here, and a special thank you to the Indian Embassy for making this afternoon possible. Although I have the pleasure of knowing most of you in this room personally, please allow me to introduce myself. My name is Saurabh Chatterjee. I'm a managing director at Chris Capital, and I oversee the firm's global fundraising efforts. I don't need to remind anyone in this room of the long economic and trade relationship between Japan and India. Suzuki began operations in India in 1982, and its collaboration with Maruti to create the Maruti Suzuki car really was what made owning a car possible for middle class Indians. In fact, my father's first car was a Maruti Suzuki way back in the mid 80s. Companies like Suzuki, Honda, Toyota, Nissan, Sony, Panasonic, Mitsubishi, and many others are all household names in India. They are so ingrained in the Indian consciousness that my 7-year-old son actually thinks Toyota is an Indian company. The economic relationship between Japan and India also extends to the financial realm. Companies like Nomura, Daiwa, Nippon Life, SMBC, SoftBank, Mizuho, and many others have made significant inroads in India on the investment management, insurance, investment banking side. And for that matter, we at Chris Capital have worked with many of these companies on the deal and investment side as well. However, the one aspect in which we feel we can definitely do more is to drive investment by Japanese institutional investors into Indian private equity and venture capital firms. The number of LPs who have invested into Indian PEVC firms in the recent past, some of whom are our LPs and are in this room today, does not match the investments that Japanese firms have made in other sectors of the Indian economy and does not reflect the incredible potential that the Indian PEVC firms present at this time. And although we have seen a definite uptick in interest from Japanese investors in Indian PEVC over the past couple of years, driven in no small part by the strength of the Indian economy, we feel that the level of interest from Japanese investors into Indian PEVC firms can improve significantly over the coming years. To that end, today we have speakers from Chris Capital and Matrix Partners, aka Z47, who will talk about the PE and VC landscape in India, focusing not only on the opportunities in the market, but equally importantly, the risks that investors should be aware of. And also speakers from Khaitan, one of India's leading law firms, who will talk about the different structuring frameworks available for foreign LPs in the context of Indian private equity venture capital and relevant develops in the legal framework. Hopefully, by the end of the afternoon, we'll have left you much more informed on Indian PEVC and much more excited about the opportunities it presents to you. I think the ambassador had to step out for some reason. So I think we can get started with the first talk of the evening, which is by Chris Capital. So Sanjay Kukreja, our partner and CIO, will come up and just talk about the opportunities in Indian private equity and venture capital.
Good afternoon, ladies and gentlemen. Real pleasure to be here and very excited that you're all here. We're talking a lot about, India and Japan today, and really the private equity opportunity. That's what I'm going to focus my energy on today. So first of all, just move from the disclaimer one sec. Move to the next slide, please. The next one. And apologize, I think we'll have to do the next slide. Call out for the next slide before we can't control it from here. Okay, so who are we? Chris Capital, and I promise it will not be about us. We're going to talk a lot more about the market, but just to put it into context, we are one of India's oldest and the largest private equity firm. We're about 25 years old. We got established in '99. We're about 55 people across 6 cities. Stable team, over 25 years of experience in general. A lot of the partners are over 20 years of experience. And we have a deep sector knowledge, sector focus around, over 20, 25 years of coverage on each of these sectors like IT, BPO, financial services, and the like. Can we move to the next slide, please? Move to the next slide, please. Sorry, we have about $6 billion of capital raised, $7+ billion of exits, alignment with LPs. Our own capital base is actually almost $300 million at 9%. and a very strong active global base. So overall, I think just stepping back, I'd like to talk to you about, since we're sitting here and talking about Japan and China, I just want to point out that most countries have gone through a long phase or period in their lives when the growth rates have been very strong. Japan went through that in the 60s and 70s. China went through that in the 80s and 90s and all the way up to 2005. And in those periods, about 20, 30 years, which have been transformational for those economies, investment returns have also been very good. Companies have found it easier to grow and scale, and and overall, combined with growth, some world-beating companies have emerged, and returns have been very, very good. So these have been good areas to invest in those periods of time. If you move to the next slide, please. Yeah, we were just talking about this period. Move to the next slide, please. So we do think that it is India's time. It has been India's time, and it's been growing at a nominal GDP growth of about 12-13%, real GDP growth of about 7-8% for the last 20-25 years. When we started investing in India at that point was not even the top 10. It was beyond the top 10 economies in the world. Today, it stands at the 4th largest and potentially looking to be the 3rd largest in the next couple of years. So we've seen a lot of transformation at play in India, but we still believe that the future, is the best is yet to come in terms of how we scale up as a country. Move to the next slide, please. So if you look at, now we talk about, so this was just overall, if you look at today's growth relative to rest of the world, you're seeing, India about 7% last year, but on a sustainable basis, real growth stands out in comparison with many other economies. But what's really interesting is it's not just growth financed by printing money. If you look at the right chart and you see, I don't know if this is working. If you look at here, debt to GDP number, what you see here is India is actually amongst the lowest in terms of how much debt we've taken as a country to get there, which essentially means that we have the dry powder in the next 20, 30 years to be able to take more and more leverage to continue to finance our infrastructure, continue to finance our growth. And because of that general discipline that we've seen in India, the strength of the economy, the strength of the companies have actually been very, very good. And also return on equity. These companies tend to be much more profitable because we are essentially capital scarce. We don't have access to that much leverage. Inflation has generally been in control in India. Used to be 10%, 8, 9, 10%. It's down now to 4 to 5%. So our macro is reasonably strong there. You move to the next slide, please. And so we believe we are set up for the phase of transformation. I think I just want to point out, while a lot of things have been talked about growth, we talked a little bit about why inflation is coming down. And if you look at this, cost of 1 GB of data, for instance, right, used to be about 200 rupees, is now down to 7 rupees. So what we're seeing is 1/10, the cost of data, which has really fueled the expansion of smartphones, how Indians interact with each other. We're amongst the lowest cost of data anywhere in the world, which is allowed for, enabled for a lot of the tech startup and that ecosystem, which I guess my friends in the next panel will talk a lot more about. But overall, if you look at metrics, maybe railways, you see all of these things. You probably see things like 5 times to 10 times in the course of 5-10 years, and that's really the transformation that's already happened and at play in India at scale. Could we move to the next slide, please? So step back to what we do, right? We are sector focused, we invest in a few sectors. Just to step back in IT services, right, which is one of the largest industries in India. At the time when ChrysCapital was set up in '99, our exports in IT services was less than $1 billion. From that point on to now, well over $200 billion of exports in 25 years, right? So it's possible in India to see scale of $200 billion and above in IT services enterprise tech, which has created a great market and opportunity for us to invest in that. And if you see similar stories in pharma, for example, 8 to 37 billion, and there's a clear shift towards financial assets that's happening, physical assets to financial assets. People are moving from, and within that financial assets, people are moving from bank deposits to equities. So these are trends that are really playing out. And I also want to point out the fact that India is not just, the story is not just about India being a poor country. It is also a country in transformation and is getting richer. So if you look at household income distribution, if you look at $10,000 and above, $10,000 to $35,000, that mix is 24% of the population already, used to be like 10, 12%, and is projected to go to almost half the population by 2030, right, or 31. So a very significant transformation, and of course, as people get richer, they consume things very differently. And that's well known. We shift from motorcycles to cars, luxury goods, etc., and all that will be at play in India as time rolls on. Can you go to the next slide, please? So all of these things point to a very positive story. India is a decade in transformation, stable macro, all of that, right? The question is, what are the risks? And the risks always exist. And I think in that case, of course, global macro and geopolitics are a concern for India. They have to sort of skillfully navigate between, the US, Russia, what you're seeing in Taiwan, what you're seeing in Ukraine. These are all flashpoints that we have to sort of, navigate our own interests and see how we do that. But we are also dependent on global supply chains, and that is an area of concern. But these are more sort of global macro concerns. But I think what is specific to India is valuations. I think the number one question that at least we get asked is, why is India so expensive? I'm going to attempt to cover that later today in the presentation. India is an expensive market and valuation is a risk. It continues to be high, and therefore I do want to specifically call that out, and we'll address that question in more detail later. I think the other major risks are, jobs. We are a young economy. We have lots of people coming into the labor force. Is India going to get richer first, or is it going to get older first, right? In that whole journey of 20, 30 years, are we going to create enough jobs, especially in the world of AI and all of that? That's creating a headwind for job creation to begin with, right? And so how do we've not had a manufacturing-led growth. We've had a services-led growth. And so job creation has been, somewhat more limited. And I think probably we'll be the only country in the world which is attempting to industrialize without a manufacturing-led growth. We are doing some of that manufacturing spend push-up. So it will not be without manufacturing, but it will be driven by services. And that's a very different model than anywhere else in the world. And then, of course, education. Our top 3-4% are actually best in the world. We produce some of the best CEOs. We produce, the IITs, IIMs have got global recognition, etc. But it drops down dramatically after that, and no country has really hit middle income and rich, has not become rich without, having fixed its education system. And so a lot needs to happen on education. That is that's area in progress over the next 20 years. And of course, inequality. I think it's topical. We had, the richest man in India have a very, substantial wedding, which was very much, covered in social media and global news headlines and everywhere. And I think this brings out the inequality in India quite starkly. I think that always remains a concern. I think in general, Indians have been very accommodative, and we've not had, violence and stuff like that. But it is something that we do call out as a risk that one has to be watchful for, especially as India continues to develop. And finally, I would say regulations, because while we have great institutions and we have great regulatory framework, I think the changes in regulations sometimes can be, more often than what we would like to see. And of course, when they're there, I think well-meaning regulators also sometimes tend to, at the point of that change, when that happens, you could see some, disruption for business and all of that. So I think it's that phase where we are going from lightly regulated to reasonably well regulated, and that brings its own set of challenges and issues and readjustments in the economy that are going out. So these are the main sort of risks that I think one should be aware of. You'll notice that I do not call out growth as a risk. I think growth in India is generally there. Quality of talent is not something that I call out as a risk. I think the quality of talent in India is superb. Quality of entrepreneurs is very, very good. And the base of consumption and all of those things we sort of already covered actually give us a lot of optimism. But these are the concerns, long-term concerns that we need to watch out for. I also don't call out, capital base or savings as a concern, because when we started investing initially, all our exits were linked to global capital. It has changed. In 25 years, it has moved towards domestic capital being the source of providing stability to the markets, whether it's equity markets or private equity markets as well, right? Ultimately are linked to that. So I see that stability also has become a lot more stable. Can you move to the next slide, please? So let's just dive into the PE landscape, and I'm going to run past this section really quick. This is more data, and then we'll get into why is India so expensive, which is I think a key concern area people may have. Next slide, please. So it's a very large market. First of all, it's not a trivial market. India we deploy as a country $40 billion of capital every year. That was 8 billion in 2009 to 13. When we started investing in 99, 2000, it was 1 billion, less than 1 billion. It was 337 million, I remember, in that year, 99 to 2000, right? So we were 1/3 of a billion. So we've really scaled as a country of how much private equity capital is coming in. But I do want to make the point that it's not a story about capital just coming in and being locked in. I think there used to be concerns around India for a lot of time. If you see the graph on the right, you see the numbers here. These are in $1 billion of exits that investors have seen out of India. And that number has used to be less than $1 billion, and all of that back here suddenly shot up, meaningfully. And so we are seeing 15, 20, $30 billion of exits every year. We as Chris Capital have seen 80 plus exits. We've taken out, well over 7 billion, close to $8 billion of capital out. So investors coming into India, the structures are well tested. 80 plus exits. We've only seen as a country, we've probably seen 400-500, exits, and totaling to well over 50-60 billion dollars in the last 5 years alone. So if there are any concerns around that, I just want to reiterate, it is not a one-way street. It is clearly enough and more exits and returns have actually been generated by investors in the Indian market. Go to the next slide, please. So these are just more sort of data that I just want to leave with you. How does it split by deal size? So it's also not, the other impression is it's all venture. Right, I think deal sizes 50 million to 500 million is actually the sweet spot, and there's a lot of deal flow in that size, right? So almost 50% of the market is actually in that 50 to 500 million, and the smaller deal sizes, 500,000, 2 million, are actually very small in terms of absolute dollars in the overall PE market of that 40 billion market. Go to the next slide, please, and you have a sectoral breakup of that. What you see there is, while that may be the case, a lot of it is still going to new economy. New economy being defined as consumer tech, startups, but actually becoming much larger. So we've broken up startups as early stage, which is 3%, and then new economy, late stage. So the same unicorns which end up becoming unicorns and then continue to go have ended up raising a lot of capital, right? And this total aggregates is about 32 billion roughly per year. And then the large sectors that we cover, enterprise tech, financial services, pharma, healthcare, are the big sectors, right? You'll notice that manufacturing is a small number, small sliver, and even consumer is a small sliver. So contrary to, this is what we talked about earlier, India is not a manufacturing-driven economy, and you're seeing the same trend in the investments that are coming into India. Manufacturing is still actually not a big driver of inflows of capital. That could change in the next 10 years as India experiments and that market opens up, that could change. We hope that changes, and that will, really create a double sort of engine for India. But services actually continues to do well for India. We're growing 7.5% on the back of services. That will continue to be the case. Go to the next slide, please. I think that we can split here. I think this is in interest of time, right? So I think other thing I would just say is the Indian market has, so there are some structural changes. When we first started investing, I think most people didn't want to do control deals at all. It was only minority and growth. I think the ownership mindset of India towards control deals has changed. Indian entrepreneurs are willing to sell companies, and therefore more than a quarter of the market has shifted towards control deals, which has created, US style deals with leverage and great returns that follow from it. And that's a structural benefit that Indian market has seen. Even now, only a quarter of the market is in that, in that frame of mind. And so if you think about the next 10, 15 years, that probably goes to 50, 60%, if not higher. And therefore, the returns will, out of India will actually improve to that extent as the market shifts more towards control. And therefore, that dynamic will continue to play. We'll talk a little bit more about that. Could we move to the next slide, please? And I think this is just, again, we talked a little bit about the exits, but exits were not just to what are the channels? IPOs have opened up, private equity exits to listed markets has actually opened up quite a bit. So if you see PE to PE exits are also gone up significantly. Stake sales in public companies after going public has increased dramatically, and PE-backed IPOs have, again, in the last few years has really gone up, right? To $3-4 billion of PE-backed IPOs, which are also providing liquidity to this market. Move to the next slide, please. So this is the elephant in the room. Is India really expensive, and how do we deal with that? And the answer to that, move to the next slide, is that it has consistently been so, but largely driven not in isolation, but long-term returns. If you see the 3-year, 10-year, I haven't plotted the 30-year, but even the 30-year data will look exactly the same. India is on the highest sort of return metrics comparable to the US or in dollar terms, right? This is net of dividends in US dollar terms, including our 3-4%, 3% depreciation that we see in the currency. Included all of that, we have delivered close to this is market returns for listed companies in India, right, as a proxy. And if you see most other markets, the blue curves are actually 3-year returns. The 10 years are the orange curves, right? So if you see the orange curves over a long period of time, India has substantially outperformed relative to most other markets. Now you can argue why is that the case, particularly if you look at China, right? Why is this 0.5%, whereas China has grown to be one of the largest markets in the world. It is the second largest economy in the world, and we'll spend a little bit of time talking through it. Next slide, please. And this is why, I mean, you see, look at the multiples in India. While we have produced great returns, that's where investor interest is much more in India, because returns have been good, and therefore multiples continue to remain high, right? So is that a continued risk? And I'm going to argue not, because I believe these multiples are structural in nature, not one time, because over 10 years and 20 years, these multiples continue to remain elevated. Go to the next slide. And I'm going to argue that the reason why our multiples are high and our returns have been good is fundamentally down to this metric, return on equity, right? So if you look at our overall return on equity here, India has delivered 14, US has delivered 14 to 15%, whereas China and the rest of most of Asia is around 8 to 10%. Now, you could argue what is the difference between 8 to 15? But I think it's the entire difference between the entire returns that you make, because remember, your cost of capital has to be subtracted from your cost of equity. So if your cost of debt is 10% and your return is 10%, you may grow whatever, you're not going to create any shareholder value at all. You need a spread between your cost of, you need to have returns of your equity greater than your cost of funds. China has not delivered that over 30 years, and which is why, over returns have been actually very, very poor. Whereas US and India have both delivered 12%, 11-12% returns, led by growth, but also led by the fact that are substantially over their cost of capital. Why that's the case is very different. US is led by technology innovation, and that's how, companies like Apple, etc., that have driven it. India is led by companies that are leading the software revolution, the pharma revolution. It's not a manufacturing-led economy. It's not a state-owned, run economy. So structurally, the kind of companies that constitute the China index and the Asia index are very different. People club BRICS together as a nation, right? You have to realize that when commodity prices go up, oil prices go up, everybody in the BRICS country is actually happy. Brazil's happy, Russia's happy, China's happy, everybody other than India, because India is a net importer. We don't have commodity benefits, right? And the other flip side is true. So the flip side of that is, because we are not commodity intensive, our return on equity actually is better. We have better quality companies in our index. And that's why we end up delivering better return on equity. That's why we are more expensive. And that's why, as private equity, we'll continue to deliver great returns as a country over the next, 10, 15, 20 years. And I haven't even got talking about why our talent is better, etc. Entrepreneurial quality is even very good. Go to the next slide, please. So you just talk here about the weight of defensive sectors. India versus China. 31% of our index is actually very high return on equity businesses like IT, driven by IT, Infosys, TCS. You look at consumer businesses, and you look at pharma businesses, healthcare businesses, versus 6%. So you can compare and say China is cheaper at 10, 11 times, but you're not comparing like for like. If you look for like businesses in China, they actually trade much higher as well. So we are not, you know, we are not at a disadvantage relative to them. The second thing is, again, if you look at the ROE of defensive sectors here at 35%, right? For IT 24 and 16, and overall aggregate to be very, very, very solid. So the point is made. I'll just move on. Can move to the next slide, please. So and we can skip this slide. I've covered this. Yeah. So we think also our alpha that we've generated as a fund is also structural. It's structural because we're fundamentally, if you look at our portfolio growth, that's been in the region of 30%, right? Or 25 to 30%. Whereas if you look at the index has delivered about 8 to 14% over this period. And that growth, sales growth, has also translated into profitable growth. Very, very high sort of growth in the on a CAGR basis on profit, and which is why ultimately we're able to deliver very strong returns over and above the index. So if index has delivered 12, our gross returns have been in the 25 to 30% range in that period, right? And that's driven because we have substantial delta between what the index is doing and what we are doing. Go to the next slide, please. So this is the alpha math that we were talking about, and while doing that, I think the risk is actually very low. So what we really measure ourselves, ultimately we're in the risk management business, right? So how do we keep risks very, very low is because the average profitability, we're not investing in companies that are yet to become profitable or are marginally profitable. We're investing in businesses that have gone through cycles, right? Average EBITDA of our portfolio is about $30 million to $40 million of profitability, so it's very stable. Average revenue is about $400 million. So these are large companies, right? And their average return on equity is 25%. We talked about, you know, India being so nice at 14% relative to most other economies being 9-10%. The reason we are able to generate the returns that we are able to do is largely because we are able to construct a portfolio which consistently does this, which means we take very little risk. Ultimately, it's about that, right? How do you manage to do, because growth ultimately provides returns, but you do it in sectors that are, you know, that end up being least risky for us. Move to the next slide, please. I think a little bit about currency risk. I think that's been talked about. I think we have suffered differential. Inflation has led to currency declining in India, and most people coming into India must, you know, budget for that. Can you move to the next slide, please? What we see is that currency actually is determined by most correlated to the difference of inflation between, you know, India's currency and the host country. So if you look at US inflation, right, and we've taken looked at over a long period of time, 1990 to 2000, US inflation was running at about 3%. Inflation, India was running at 9%. I talked about that, you know, 9-10 coming down substantially now. So that delta was almost 6%, which led to almost a 9% depreciation annually in that period of time. Come to 2001 to 2007, US inflation was still 2.7, but we had 4.6. Right? Our inflation structurally came down, and therefore actually rupee appreciated in that period of time. 2008 to 13 we suffered, again inflation went up because oil prices went up, and this was a period where we had, you know, global financial crisis, oil went back up to $100. That led to, again, depreciation, US dollar depreciation around this point, but not anywhere close to that. It's been like 3-4% here. And now inflation differential is again almost negligible. India is like now coming down to 4.5, US maybe structurally 3-4%, now going down to maybe 2% over time. So our difference, if it's only 1 or 2%, we think that depreciation may be limited to 2%. And I think that is totally manageable in the growth and the context that we see in India. We move to the next slide, please. So again, there's a strong case for why inflation is already at 5.8, but I think if you look at excluding food inflation and oil inflation, it is actually down to 2.5-3%. It is really oil inflation that keeps coming out, which has an issue. But over time, if you think about 30 years, fossil fuel-based inflation is actually only coming down as the world's reliance is moving away from fossil fuels, and that's going to be hugely positive for India. So India has done what it has done with this dependence on fuel. I think by 2030, almost 50% of our energy requirements move away from fossil fuel into other fuels. And so, and if you extend even further into the future, I think that is actually a tailwind for India, because we are going to get diversify away from fossil fuel, and we haven't yet seen the benefit of that in our macros. Move to the next slide. And our CPI, if you see, which is why you see these numbers here, which gives us a sense. And you look at Brent crude, it's been very volatile. We've covered this. You move to the next slide, please. This is the 50% diversification that I talked about. Very strong growth in solar, very strong growth in renewable energy that we are seeing in India. It's going up in multiples, not in percentages terms at this point, and therefore by 2030, we'll diversify away our risk from fossil fuels. Move to the next slide, please. You move to the next slide. Yeah, and also the other big thing is logistics cost. As a country, we are investing behind infrastructure for the first time. So if you go into India, if you've been there last 5 years, you can see a material shift in the number of highways, in the number of railways that we are creating. Therefore, logistics cost is actually coming down. And the government has given a target of saying 13% of cost comes down to even 9%. So that will help bring down inflation even further. Could you move to the next slide, please? I think this is worth calling out. I think you've seen in India, world over, Indian story has been very different than everywhere else in the world. We have seen prudence in India where everywhere else we've seen massive sort of, currency printing. So if you look at the size of central bank balance sheets, right? You've seen many multiples of how much they've expanded between 2007 to 2023 US, for example, right? UK has expanded dramatically. Even, Japan we haven't got here, but BOJ continues to follow a very expansionist, monetary policy. So India has not had that. Our debt to GDP is in control. We were very disciplined through COVID. I think that creates the ability for us to do and navigate future shocks very differently than, where other countries are, where they don't have that flexibility anymore because they're maxed out on debt to GDP ratios. So I think that's another element of risk that I do want to call out. Move to the next slide, please. Again, I think this is just useful to see and sit back and see what is possible in India, right? So if you look at the corporate profit pool in India, here, we were $26 billion, companies with $1 billion of market, market cap here, right? That has gone from 26 to 512, right? In public space, and in the private space, you got 11 to 113, and those profit pool of those companies was, 5 billion has gone to 217 billion, right? So it is conceivable in the future that we go from 200 billion to $1 trillion of profit, yet in 10 to 15 years, and you put whatever multiple to it, 15 times, 17 times, whatever you're comfortable with. The financial markets at 217 billion today, our GDP, our overall market cap, listed market cap is about $4 trillion. If you go from 217 to $1 trillion, and you put 15 times or 17 times, you're going to get to a 15 to 17 trillion dollar market. So India is not just growth, but it's growth at scale. You don't have 15 to 17 trillion dollar market cap, financial markets anywhere else in the world. You have it only in the US and to some extent China. There's no other, market. So we are in that phase where we are going from $4-5 trillion of market cap to maybe 15-17 trillion dollars in the next 10-15 years, and that is going to be a great journey. And we feel like that can be taken advantage of by the private equity route, by venture capital, by various folks and various opportunities from corporates, and which is why I think the whole Japan-India dialogue and conversation is going to be very interesting, because Japan is capital rich and does not have some of the things that India has, which is growth, average age, and some of the other things that are really in favor of India. And I think we can definitely benefit mutually as countries. So I'm going to pause here, and we have a couple of slides just talking about why control deals have worked. Can you move to the next few slides, and then we just stop. So this is the last topic that I'll talk about, how India has shifted from a private equity side towards control deals, and that will end with that. Can you go to the next slide, please? And maybe just the market, I said, has already gone to 30. I'll just give you our own example. Can you go one more slide, please? Yeah, if you look at this. So, our share of control was less than 10%, 3%, almost zero in the first decade. From that, we've gone to almost 60% of our deals have already moved towards control deals, control or joint control. So it's a very significant shift, and that's what's also driving the returns that we are seeing. And frankly, this is moving only up in one direction, overall the market, as well as for us. Okay, I'm going to pause here. I think we had 40 minutes to cover this. I probably have covered it in that time. Lots of slides. I apologize if I've rushed over something in detail, but I want to just quickly summarize. I think India, stepping back, I do feel like India has already demonstrated about 15-20 years of very strong, stable growth, nominal GDP growth of about 12-13%, which has allowed us to back companies in the 25-30% growth. So growth is actually very relatively strong. It's not just growth; it's coupled with very profitable companies because you have high ROEs in the economy and very good entrepreneurial talent. The risks remain pricing, risk remain education, risk remain jobs, right? And overall, I think as a country, the opportunity will belong to people who can execute on that. We have size and scale in India, and I think we can open it up to any questions if people have, and then move to the next speaker after that. If you have any questions, feel free to raise them. Get a mic across. You could come here and ask. Okay.
Just a moment, friends. Since you are seated in the Indian Embassy, it is incumbent upon me to welcome all of you on behalf of Honorable Ambassador of India to Japan, Mr. C.B. George. He had to go out because of exigent business. I would just want to give an overall picture about Indo-Japan relationship. I know this is a very specialized topic, and all of you are already, know about India. And yesterday, our finance minister presented a wonderful budget on very strong macroeconomic fundamentals. I will just read out the message of Honorable Ambassador. Basically, he wanted to welcome all of you to the seminar today. And especially, he wanted the Japanese investors to look at India very positively. Today in 2024, we stand to celebrate 10th anniversary of the Indo-Japan Special Strategic and Global Partnership. We have excellent political relation. Even any kind of economic and financial dialogue will always stand on a political base. And India-Japan, fortunately, has a wonderful relationship spanning decades. So, in fact, whatever presentation you have seen, this picture will be reinforced by the fact that politically we are very close. We have people-to-people connect, culture-to-culture connect. I wanted to convey also that over the years, India and Japan's relationship has deepened, especially in infrastructure, defense, technology, energy, to name a few. Indian economy, you already know enough. We are growing at 7%, and the next 30 years, which we call as Amrit Kal, 2047, we will be celebrating 100 years of independence. We wish and we hope and we will become the second largest economy in the world. And in that, we need Japan as a partner. And you are already aware that we have an excellent startup ecosystem. We are the third largest ecosystem in the world, more than 70,000 startups. You have already seen a picture here. And just want to mention two more important things. Our swift adaptation of digital payments. India has invested on the digital public infrastructure. It is a very, very big futuristic investment that India has done, and on that rides a lot of business and other technological and innovations. I would welcome you. The welcome is somewhat got diverted because of a little exigency, but I welcome you to this seminar, and I hope you gain enough information on India and specifically this topic. Thank you.
Our Minister, Economic and Commerce, Embassy of India, Tokyo, conveyed a message on behalf of the Ambassador of India to Japan. Thank you. 駐日インド大使館のデーバジャニ・チャクルバリティ経済商務担当講師が大使のご挨拶を代読させていただきました。質問に移ります。
Yeah, thank you very much, Devajani-san, for your encouraging comment. I believe that today's the audience should have enough passion to expand the Japan-India corridor. And Sanjay-san, thank you very much for your presentation and with the deep insight. I believe the Japanese companies' appetite to take Indian exposure has been dramatically increased in the past 5 years. And my question is, when did you feel that? My first question is, when did you feel that your real experience to feel that on some event or some episode can be shared? It will encourage the Japanese investors. That is my first question. And the second question is, even with under such trend, the many Japanese institutional investors still hesitates to take Indian exposure. How do you analyze those reasons? You have already mentioned 4 concerns, but if you have some feeling among of 4, that is the biggest reason, or other than those 4, it should be a highest barrier. If you can share any comment on that point, it would be also appreciated. Thank you.
Thank you so much for your question, and I think very valid points. So first of all, I completely agree that the interest in India from Japan has been increasing over time. I think Saurav's with me. We used to come earlier, probably used to get 5-6 meetings. Now we get 40-50 meetings. I don't know. It has gone up quite a lot. We see that in interest from inbound interest that we see from Japanese firms. We see it in the IT services sector when we look at strategic exits for some of our companies. Some of the Japanese corporates are quite keen to come in and acquire businesses. We've seen some very large transactions that have happened in enterprise tech space. So Japan is becoming more and more meaningful for India. And I think strategically, as I've said, over the next 20-30 years, because of the basic nature of excess capital and India becoming a certain size and scale, it will draw that capital from Japan, and from other parts of the world as well. So I think it has happened. I will not be able to point to one tipping point, as is always the case. It's not typically once, change happens gradually and then all of a sudden, right? And that is the nature of, change. And I think India's point happened about 3-4 years ago, 5 years ago, when a lot of interest started to come in, and I think that trend is likely to continue. It's also because, when we sort of became, we broke into the top 5 economies in the world, people started taking notice of that. I think our financial markets became like the 3rd or the 4th largest. People started taking notice of that. And therefore, the size of the opportunity became larger, and everybody started to understand that 5 could go to 10 in, when we talked about, Amrit Kal and 2047 is a very, that's a very long-term view, but even getting to the 3rd largest economy might be possible in 2 or 3 years, right? So those things are becoming, capturing the imagination of global, decision makers, global boards. We are seeing more and more global boards being held in India, people coming in and hosting global boards. We get requests to address those boards at various points in time and talk about the India opportunity. So we are definitely seeing that. I think amongst the risks, I think the biggest risk, frankly, is the number 3, which I talked about: jobs, inequality, and education, which is more longer term in nature. I don't think that blows up in a year. I think our growth from $2,300 per capita income to maybe $4,000-5,000 per capita income is reasonably certain, and the pathway is clear. But we'll have to, to get beyond that, it will be productivity gains, it will be, gains driven by education, gains driven by, really on the job skill and training in a world which is going through AI sort of, job reductions. That is going to be, different. And remember, we are in a world where owning assets is driving a lot of the return, even in India, versus just job creation. And so if you don't, the difference between haves and have-nots is increasing. So I think those are the concerns that one would have. And I think India is a democratically elected government. Every year, we go through budgets, and every state government tries to give out more to the people. So to address inequality, our education spends are going up, right? So it's not as if the government is unaware or the private sector is unaware. I think the one other thing is civil society in India is coming together in a major way. You're seeing philanthropic capital. I don't know if any of you are aware of this. India has a rule: 2% of all profits goes into CSR, corporate social responsibility, by law. And like I mentioned, our profit pool has gotten to $200 billion. So 2% is not a small sum of money, and that pool is increasing at the rate of 13-14% per year. So our CSR capital is actually increasing dramatically, and that is going into areas like these: education, fixing on-the-job training, fixing productivity, ITI colleges and all of that. So I think those are getting fixed, but it is a risk, and I would call that out. Yeah. If there's any other question, otherwise we can move to the next speaker, please. We don't have a mic, so you'll have to come here. So I'm sorry.
It is quite embarrassing to go to this first, but thank you very much for really a comprehensive explanation and the description about the private equity market in India. I'm in the control deals is significantly increased, like 6% of maybe its amount, right, of your investment is now moved to buyout and control deals. How is the market as a whole? How is the ratio of a private equity market, besides including your firm, but how is it generally over time changing?
So the market has gone from 0% in 99-2000 control to 25%. 1/4 of the market is control deals.
Currently.
We are 60%, but the market overall, including us, is 25% control.
So did you have some kind of regulational reason that you could not?
No, so it's not regulation. In fact, regulations are still very bad on control deals. We're still not allowed leverage. It might be called, as a country. Those things are going to change in the next 10, 15, 20 years. All positives, further positives that will happen. The reason it has changed is because the mindset change of Indian promoters. They weren't willing to sell earlier. And also remember, India went through its economic transformation in 91, with liberalization.
Right.
So a lot of the first generation entrepreneurs set up companies in 90s, late 80s, early 90s. And so there's a generational change. The first generation has been very passionate about that, but now they're 30 years, 40 years into setting up that business, and they don't often find the next generation willing to take it up. And private equity capital as an alternative has emerged, so they're willing to sell business and move on. So that's what's driving it.
Okay. How do you?
Can we? I'm available. We will, we will chat post this and take it up in coffee. Thank you. Thank you very much.
Would now like to invite Mr. Tarun Davra and Vikram Vaidyanathan from Matrix, a leading Indian VC firm, to talk about the venture capital opportunity set in India.
Thank you, everyone. Firstly, welcome. Really exciting to see all of you over here. I'm going to be talking about Matrix Partners India, or Z47, which is our new name. We just rebranded 2 weeks ago, so I'll tell you about that story as well. And it's great to see a lot of familiar faces. I was here in Tokyo about 6 months ago, met a lot of you one-on-one, so it's great to reconnect with all of you. Thank you again for coming. So quick background on the firm. We can actually move to the next slide. So Z47 is an early stage venture capital firm. We typically invest very early in companies. About 60 to 70% of the dollars that we invest are at idea stage. So we start between seed rounds and invest till Series B. So we go really, really early, unlike our friends, who invest in more mature businesses. In terms of our history and background, we've been investing in India for the last 18 years. We originally started with a partnership with the Matrix Global platform. We are currently investing out of our fourth fund in India. It's a $550 million fund. Across 4 fund cycles, I think we've been fortunate to work with several outstanding entrepreneurs, and we'll actually talk about some of their journeys as we go through this presentation. We currently manage about $1.5 billion in assets under management across these 4 funds. Quick context on the Z47, and thank you to the embassy and to the ambassador for inviting us to do this. The 47 is actually inspired by the vision of Viksit Bharat. The Prime Minister in his speech last year had actually put out this statement that India aspires to be a fully developed nation by 2047. We believe the startup and the digital ecosystem will have a big role to play in helping India get there. And that's the sort of inspiration behind our name as well. And then the Z actually has a karmic connection with Japan. The Z is inspired by Zen. So it's actually great for us to be here and actually do this together with all of you. So again, thank you. Next slide, please. One back. Some of my photograph is turned around, I don't know how. But quick introduction, my name is Tarun. I've been with the firm now for the last 12 years. At Matrix, I lead our investments in consumer tech. So I've invested across EVs and mobility, across e-commerce and marketplaces and gaming. I also have my partner with me, Vikram, who's actually going to be covering the second part of this presentation. Vikram has been at the firm now for the last 14 years. He leads our investments in financial services and enterprise software. In terms of quick team introduction, the top row, we're a stable team. It's a stable partnership. The 5 of us have been in business together now for the last 12 to 17 years. The middle row is the younger set of MDs and principals. I think what is unique about Matrix relative to some of our peer firms is every single person in the team actually comes from a strong operating and a entrepreneurial background. So every single person has actually built businesses and operated businesses in the sectors in which they invest today. And that's a big differentiator for us on the ground. Next slide, please. These are some of the businesses that we have been fortunate to be associated early. In every single one of these companies, we have been the first and earliest institutional investor on the cap table. Each of these businesses are today well-known, well-respected, and well-recognized as the category leader in that particular domain. So as an example, Razorpay is India's largest digital payments company. It processes about $150 billion of TPV today in the country. We were the first investor that seeded that company. It's like the Stripe of India, for those of you who know the company. Ola Electric, as you know, is India's largest electric vehicle business. It's the Tesla of India. About 55% of all electric vehicles sold in India are Ola Electric today. Again, we were fortunate to be early partners with Bhavish and were the first investor on the cap table. Off Business is India's largest online B2B marketplace and platform. It's a supply chain fintech. They today are the largest B2B platform in the country as well. Actually, the entrepreneur of this company was earlier at Matrix India, or Z47 now, and when he spun out to start up, we backed him. And I won't cover all, but I'll maybe just cover one more. It's because it's a well-known company. This is Ola. Ola is like the Uber of India. It's India's largest ride-hailing platform. Again, we were fortunate to be amongst the earliest investors in that company and have continued to back the entrepreneur across multiple of his businesses. Next slide, please. So these are the 17 most valuable venture-backed companies in the country today. All these businesses are real. 1/3 of these companies are already public. 2/3 of these businesses are profitable. We've picked all companies with a market cap of at least $5 billion. And apologies, I think some of the alignment seems to have gotten sort of messed up, but hopefully we can still follow. So these are all real businesses. These are all venture-backed. About each of these businesses are $5 billion. I think what you'll see over here is there's two things that, and on the right-hand side, you will see the logos of the early stage VCs that had backed these businesses, right? Backed as in between seed and Series B, so early stage investments. I think you'll notice two things on this slide. One is there are 4 or 5 names that consistently get into the best companies early. And we get asked this question a lot, which is, for a market which is as exciting, as attractive as the India venture capital market, why is it that there are only 4 or 5 names that matter? And our response is, India has not been an easy journey. We've been there for the last 18 years, have enough scars on our back to prove it. There were a lot of venture capital firms that had set up base in India almost 2 decades ago. Some of them folded along the way. There are few that survived, and the ones that have survived today have built a very strong brand recognition, a lot of trust with entrepreneurs, a lot of trust with sort of institutional investors. And those are the firms today, because of that reputation, are consistently able to get into the best businesses. And the second thing, again, this is, I promise you, will be the only marketing spiel from my side. The second thing is, we're proud that we, amongst all these VCs, we have the highest market share of the most valuable businesses. So 5 out of these 17 logos, Z47 was the early investor in, and then some of our peers have, a few less than that, right? So we're proud of the fact that while being very thoughtful and very measured on the capital that we've deployed, we've actually raised and deployed the least amount of capital compared to our peers, and yet we have the highest market share of the largest businesses. Next slide, please. So I'll spend maybe a few minutes on the India macro, and I'll talk to you about what excites us. I think Sanjay at Chris has already done a fantastic job and made my life easier because he's hit several of the points I was going to make. So India is the fastest growing large economy at scale today. We continue to grow well north of 7%. In fact, in the last 4 quarters, GDP growth has actually exceeded government forecasts, which is a first in India. For a long time, we haven't seen that happen. And, that makes us very, very optimistic. A lot of that investment, by the way, is actually going into digital public infrastructure development, which Madam spoke about, and also sort of now starting to build the manufacturing story. As the realignment of supply chains outside of China starts happening, India is actually poised to take advantage of that. And hopefully we'll start moving some of those supply chains towards India as well, right? And so both of these are big themes. A lot of investor capital is going there. And we also continue to have investments across both of these. Next slide, please. India is on track to be the 3rd largest economy by 2028. I think Sanjay also mentioned it, and hopefully in the next 3 or 4 years, we should get there. I think what is unique about India, while it continues to be a very high growth economy, it's also a very young country. More than 2/3 of our population is under the age of 35, which actually makes for a great sort of story, because hopefully even when we get there, there is a large population of working people that are income generating, that are able to further propel the economy from there on. Next slide, please. So, Madam spoke about the digital public infrastructure. Honestly, a lot of the innovation, a lot of the inflection in our startups that we are seeing is on the back of this government-built digital infrastructure. It started with the digital identity, and I'll actually spend 30 seconds because I don't know if everybody's actually familiar with that. I'll actually talk about what was put in place. Then we built a payments layer on top of it, and now there are multiple applications of the data layer that are being built on top of that. So I don't know if all of you are familiar, but India set up its Aadhaar project, which is a digital unique identity. More than 1.5 billion Indians got a digital identity prior to 2016. It was probably the most ambitious project at scale anywhere in the world, let alone in India. With each of these digital identities across the entire population, there are two things additionally that were done. One is there was a digital biometrics. Second is it was linked to the individual's mobile number and to the bank account. And I don't think this has happened anywhere else in the world, where there's an individual, there's a unique ID of that individual, there's a digital biometrics, and then it's linked to your mobile number and to your bank account. Now, what that enabled is essentially us to set up a frictionless real-time payment system on top, where any individual in the country can transfer money to any other individual in the country free of cost without knowing the other person's bank account details. All I need to know is your mobile number, and I can literally transfer to you, 1 yen at zero cost to either of us. And it's real time, it's instantaneous, it's across the banks. Now, this has been done in some other countries, but it was largely driven by maybe one or large private businesses. I think what is unique about India is this has been built on open source rails that the government put, and then private enterprises can actually build on top of those rails, which is really unique about India. The third is now data, and we can see that in multiple different applications, where, for example, if I'm a credit card business in India, if I had to earlier apply for a credit card, I would fill up a paper form, I would need to send my KYC documents, it would go to some call center, there would be some form missing, it would come back to me, the whole process would take weeks. Today, as an Indian, if I want to get access to a credit card, I can literally apply on my mobile phone. There's a digital video KYC, which is real time and instantaneous. It links to all my backend, all the digital infrastructure the government has put on top. And within 3 minutes, I can get a credit card issued real time to me on my mobile phone. And then the physical card will come in post in the next couple of days. So I think the world has really, really changed. There's a lot of stuff which is happening, which I think is sort of world class and best in class today, which is actually allowing these companies to grow very, very rapidly. Next slide. So having had that context, I'll actually walk you through, I think somebody asked the question, why now? Why is there all this sudden interest in India all of a sudden? Why have suddenly such large, digital businesses of scale been built in India? And why has it all sort of come together in the last 2 or 3 years? And I think it's important to have this context to understand what really is going on the ground. So if you see in 2020, COVID happened, a lot of companies actually inflected and started growing very rapidly post-COVID, driven by the sort of post-COVID digital inflection. I think it's important to understand if the building blocks that were being put in place well before COVID hadn't have happened, I think the story would have played out very, very differently. So if you see in 2020, we had COVID, like I mentioned, but if I go all the way back, I've spoken to you about Aadhaar and sort of, the UPI and the payment system that was put in place. In 2016, we had Jio, which is the world's largest telco launch. They crashed data costs by more than 90%, which made cheap sort of high-speed data available to every Indian across the country. TikTok launched around the same time, which made the average Indian start spending hours a day consuming content on their mobile phone. It got people hooked to sort of consuming content. And then demonetization happened, right? And different people have different views on whether it was a great move politically and economically. But as far as the digital ecosystem is concerned, it was probably the best thing to have happened, because overnight, hundreds of millions of Indians were forced to start experiencing digital payments for the first time in their lives. And once you go there, you never go back, because you just know how convenient and frictionless it is. Then GST was launched by the government in 2017. Again, a very, very ambitious project. It brought the entire tax code of the country under a single umbrella, and it sort of unified the tax code across all the different states. And then different versions of UPI happened. So if you see the life of the average Indian prior to all these changes, they were digitally dark. They weren't on the internet. They had no access to online payments. A lot of the subsidies, there was a lot of leakage because of corruption. Contrast that to what's happening today. We now have 1.5 billion Indians, all digitally connected, all savvy, all of them accepting digital payments, either as small-time merchants or individuals, and they all are spending time on the internet, actively transacting and consuming services. The world has changed. in these 4 or 5 years. And I think that's the context to understand why suddenly these startups and these businesses are starting to grow so rapidly. Next slide, please. So we've spoken about digitization, which is one big lever. The second lever is GST, which we also covered, which is the central tax code. There's a big investment in government infrastructure, and we'll talk about some of those changes as well. And then finally, manufacturing. There's a very interesting statistic. Government is actually, this is a big push for the government. I think, Sanjay also alluded to sort of manufacturing as a big push. 3 years ago, less than 1% of the iPhones sold around the world were actually manufactured and assembled in India. In just 3 years, today, 1 in 6 iPhones sold in the world are assembled and manufactured in India. By next year, 1 in 4 Apple iPhones sold in the world will be manufactured in India. That's how rapidly this alignment of supply chains is happening, right? And the government is making a very big push to make this happen across electric vehicles, semiconductors, and several other sort of areas of strategic interest. Next slide, please. And you can see that in the data. If you see the percentage of population with bank accounts, it's gone from 55% to well north of 95% today, thanks to a lot of the push by the government. If you see digital payments, that one little blip in the middle, actually I have this, I can use that. That one little blip in the middle is the first COVID lockdown. So you can see that the UPI and the digital payments was growing, but it was fairly incremental prior to COVID. And then you can actually see the hockey stick growth that has happened after that, right? And that goes back to the timeline chart that explains what actually enabled this to happen. Next slide, please. Tax revenues obviously have been growing at a very healthy rate. India is one of the few countries where tax revenues continue to grow well north of 25%. India has also done a fantastic job on fiscal sort of prudence and fiscal deficit. Our fiscal deficit is consistently been coming down and will projected to come even further. That's unlocking a lot of capital from the government. Next slide, please. Where we can actually, if you see our capex as a percentage of nominal GDP, it continues to keep going up, right? All of that capital is now finally being put to actually improve highway construction and into ports and other sort of physical infrastructure. So I've always believed that physical infrastructure in India is probably a decade behind where all of us would like it to be, right? And that's the reality. But digital infra, we are world class. Today, finally, one can say, even on the physical infrastructure, we're catching up. And if you see images on the next slide, please. So this is the vision of India that a lot of people who have visited many, many years ago would have, broken roads, crowded trains, crowded streets. But the reality is, this is also the India. These are not CGI generated images. These are actual images of all the new infrastructure that is being put in place by the new government. There's, bullet trains, thanks, in partnership with Japanese firms. This is a coastal road that's come up in Bombay, which has cut travel time from 1 hour to 12 minutes. There's a trans-harbor sea link, which is one of the world's largest trans-harbor sea links, and there's all sorts of other things that are happening. And so it's really fascinating to see India go through this growth journey where we kind of leapfrogged, put all the digital infrastructure in place, and now sort of the world is actually picking up some pieces of it. But now on physical infrastructure, as the country gets richer, we actually have more money to start investing in that as well. Next slide, please. So this is, I spoke about sort of the government push on manufacturing. So the government has actually done a really smart thing to enable manufacturing and to encourage entrepreneurs to sort of build in India. What they're doing is they actually come up with production-linked incentive schemes, which are rewarding companies that are following local sourcing and local manufacturing norms with certain incentives. So just case in point, I mentioned Ola Electric is one of our portfolio companies. Ola Electric is today India's largest EV business. Within 3 years of launch, the company has already filed to go IPO. They've scaled from 0 to $700 million of revenue in 3 years since launch. They continue to grow very, very rapidly. They've just received government approval to list on the public markets and hopefully should be listed in the next 15 or 20 days. That company has raised about $700 million of equity capital in its lifetime. On the back of that, it's received more than $1.2 billion of government PLIs. Now, what that does is, A, it actually improves my return on equity as an investor, because that $1.2 billion would have otherwise been equity capital that would have diluted me. The second thing is it actually makes sure that companies that are doing the right thing, where they're actually investing in India, building IP in India, making new jobs in India, are getting rewarded in the right way. So it's not just simple sort of assembly operations. And then, we spoke about, all the other manufacturing activity, and this was the stat I was mentioning. From just 1% of global iPhones in the world being manufactured in India 3 years ago, in next year, 1 in 4 iPhones produced in the world will be sold in India. Next slide, please. I think this is, something which is very, very exciting. China went through the middle income journey between 2007 and 2011, where they went from $2,500 GDP per capita to about $5,500 GDP per capita. India is going through that same journey as we speak. We are currently at about $2,800 GDP per capita. We will get there. We may not do it in 4 years like China. We will probably take the next 7 or 8 years to get there, but we will get there. And typically when that happens, financialization of assets and wealth, more higher spending towards discretionary sort of consumer areas, all of that goes up. Those are the sectors that we invest in. And typically, these phases are also correlated with the highest investor returns, right? Next slide, please. And we can already start seeing that in sort of early data points to prove, as proof points. So housing sales, if you see, in the last 5 years have more than doubled in the country. If I look at air travel, last year 480 million Indians did some air travel. Credit cards issued in the country have more than tripled in the last 3 years. And again, these are just sort of indicators of increasing sort of wealth amongst people. And then finally, retail public investments. This is the equivalent of the 401k, or these are small checks that go directly from your sort of salary check or from your bank account directly into the public markets. That number today is actually close to $30 billion a year. It was 5 billion just 5 or 6 years ago. So it's dramatic how quickly these things are actually changing on the ground, which makes for a fantastic environment for us as early stage investors. Next slide, please. There are risks. We can't talk about rewards other than without sort of keeping a watchful and thoughtful eye on the risks as well. So if you see, I think Sanjay already called out income distribution. That is one key challenge. And as India actually matures from being a services-only economy to a manufacturing-led economy, hopefully some of that will get addressed. Venture, I think the elephant in the room, and for all of you who've been investing in venture across the world, that historically cash returns have not been as strong, particularly from India. And my partner Vikram will address that. A large part of it is, investors used to ask us, our LPs, which are largely endowments and pension funds over the world, they used to ask us, all this is great, but why is there no DPI? Or why is there, sub sort of standard DPI? And our response always was, listen, the lack of IPOs and the lack of, cash returns is a symptom of the problem. It's not the problem. The real problem is the market isn't deep. And the good news is that has changed in the last 3 or 4 years. And my partner Vikram will actually show you underlying company operating data where you can see, I've given you some of the macro things that show how the market has deepened in the last 4 or 5 years. And that hopefully should bode really well for returns in the future. But Vikram will actually talk to you about underlying portfolio businesses and how rapidly those businesses are growing. Because eventually, you need to get to businesses of scale that can list on the public markets. And you need those businesses to be highly sort of cash efficient. And that's also starting to happen. I think this was a risk earlier, where a lot of the first version of sort of startups tended to be, A of, X of India and, Y of, India. I think today a lot of the startups are made in India, made for India business models, where we're actually seeing ideas that haven't sort of, worked anywhere else in the world, actually starting to work in India because these are made for India models. Capital flows, there was a time, I think somebody, Sanjay also alluded to this, there was a time where 2 or 3 investors used to come in, move the market. Either it was very hot or it was a funding winter. I think we're well beyond that now. I think there is a much more stable, well-diversified pool of late-stage capital that ensures that the companies that we back continue to get capital as they scale. Deepening of capital markets for digital companies. Vikram will actually talk to you about the amount of capital that is available for some of these businesses once they list. And then finally, regulatory risk, which Sanjay has covered, so I won't cover that. So when I put all this together, next slide, please. Sorry, I think we missed one slide. Can you just go back one slide, please? Okay, I think there's some issue. There's one slide which was supposed to be there, which is missed. There is a chart which talks about the 2 trillion. Maybe I'll just cover that and then I'll hand it to Vikram. If you can just go forward. Just keep going. Yeah, just keep going. Keep going. Yeah, this one. Sorry, I think somehow the order seems to have changed. So I'll just cover this slide and then I'll hand it over to my partner Vikram to cover the rest of it. So the title of our presentation was $2 to $3 trillion of incremental digital market cap that is coming in the next decade in India. And I know that sounds like a really large number. It's not something that we just took out of our hat. There is a underlying basis to it. So India today is about a $4 trillion GDP economy, right? Typically 1:1 GDP to market cap. Our market cap is between $4.5 trillion today. Today, if I take all the listed tech companies and the unlisted unicorns all put together, about 5% of that $4 trillion market is digital or is tech companies, which is about 250 billion all put together. If I were to fast forward over the next decade, India will be a $10 to $12 trillion economy. At that stage, our estimate is that 20 to 30%, which is about $2.5 to $3.5 trillion, will be tech market cap. Now, why 20 to 30%? If I were to just look at what happened in the US between 95 and 2010, when they went through their sort of digitization journey, and when I look at China, when they went through their journey in mid 90s to early to 2005, each of these actually went to that 20 to 30% of their market cap was tech companies. In fact, if I look at the US today, just FANG itself is well north of 30%, and overall tech market cap is like 45% plus. So I think 20 to 30% is a fairly conservative estimate. If I just do that math, again, it's not rocket science. If I just do 20 to 30% of this, that's additional $2.5 to $3.5 trillion of tech-driven digital market cap that's coming in the next decade. And that's where we play as VCs. I think some of that value will go to incumbents. Obviously, there's some existing listed companies. It's a small set of companies, about 15, 20 companies, but a large part of that is going to be new venture creation, right? And that's where we play, and that's what makes us optimistic about the next decade. So with that set up, I'll just pause over here and I'll hand it to my partner Vikram. Thank you.
Thanks, Tarun. Can I request you to go back a few slides with the pictures of the founders? Yeah, this is fine. My name is Vikram. I've been investing in early stage startups for the last 14 years at Z47, and I split my time between financial services on one side and enterprise software on the other side. What makes us very excited at this moment, and Tarun covered a lot of the macro, and I'm going to cover a lot of what's happening in the venture environment, which is what's happening with the startups. What makes us very excited today about that startup environment is 3 things are coming together, which is markets, founders, and exits. 3 things are coming together at the same time. First, we've never seen markets as big in each of our sectors as we'll see. Second, we're investing in a set of experienced founders who are able to take advantage of these markets. And third, because of the fact that our public markets have become deeper, there is a way for us to exit these companies in these markets. Next slide, please. So instead of giving you a sense of large markets in financial services and so on, we thought let's show you a few companies which brings this to life. So these are all companies which were all founded between 2012 to 2014. So they've been about a decade in existence. And you'll see that right around COVID, till about that time, some of these companies were big, but not that big. And you can see suddenly all of these companies have become very big in a short period of time. So if you take off business, and this is an interesting company which is in commodity supply chains like steel, agri commodities, and so on. That company is now run rating at close to $500 million of revenue and close to $100 million of profit. We just didn't have companies of this scale today. Five-Star, it's a financial services company which we took public in 2022. That company is run rating at 300 million of revenue and 120 million of profit, and so on. One of the other things I'll point out is this is in the manufacturing and commodity supply chains. This is in financial services. Razorpay is the largest payment gateway. It's in payments. Ola is in consumer mobility. If you go to the next slide, you'll see some of our companies which are much younger. These companies were founded only in 2018-19, all of these companies. But they have gotten to the same scale as the previous set much faster. Why? Because the markets are deeper, and therefore they are able to hit significant revenue scale. Ola Electric, Tarun has covered in detail, so it's pricing to go public right now. And that's happened in a rapid period of 4 years. OneCard, it's a digital credit card company. That's now at $250 million and just turned profitable. Again, each of these companies, this is in digital cards, which is financial services. This is manufacturing and auto, electric vehicles. This is in consumer brands, and this is in software. So again, it's different sectors driving this. The next slide makes the same point, so I'm skipping this. Go ahead. Go ahead. So the first point I made was around market. Companies are becoming big, they're profitable, and they're getting to that profitability and scale much faster. The second thing that is happening is now we've had 15 years of this startup ecosystem. And so most founders are on their second startup or third startup. So if you look at around 7-8 years back, we had 13 companies valued more than 500 million. We had about only one of them, which was founded by somebody who was an experienced founder, and therefore the hit rate was very low. If you look at it today, there are close to 100 of these companies. 50% of these are founded by an experienced founder. They're on their second, third startup, their hit rate is much higher, and their probability of success is now higher. In that, as Z47, we have extraordinary market share. We have 25% market share in the experienced founders, and that's where we are strongest in that market. Go ahead. What do these experienced founders look like? And we've tried to actually, this is part of our playbook to figure out who do we actually partner with and how do they become successful. Usually these experienced founders are, like I said, have a track record of success. They've sometimes sold a company, made tens of millions of dollars already, and they're starting the company for the second or third time, and they're starting it to build something very, very large. They're usually building in this in domain, which means that if you're in financial services, you start in financial services. If you're in steel, you start in steel. If you're in auto, you start in auto. And that's very important because your experience then helps you make better decisions. They usually have capital following them, they usually have teams following them, and they usually are building profitable businesses from the get-go. Let me give you a couple of examples. OneCard is a company that we just covered, which is a digital credit card company. The team helped build the credit card business at ICICI, which is one of India's top 4 banks. So they built the credit card business there, and they wanted to do a digital first card, and we funded them right out of the gates as they came out of ICICI. Deserve, it is in the investment space. It's an investment platform. That company is founded by 3 founders who helped build IIFL, which is one of India's largest wealth platforms, and they wanted to do something which was more digitally led, and we funded them as soon as they came out of IIFL. So that gives you a sense of these are people who are 35 to 45 years of age, have really built or run scaled businesses, and then they are starting up, and that's who we end up partnering with. The story is similar across all of these. Go ahead. So where is this happening? Is this happening only in pockets, or is this happening in all sectors? For us, what we are seeing, it's happening across sectors. It's happening in e-commerce, fintech, health tech, software, and so on. I think there are several new interesting opportunities which are nuanced and specific to India. I'll just call out a couple of them. One is advanced manufacturing, and we're seeing opportunities that come up whether it's in semiconductors, it's coming up in AI, it's coming in electric vehicles where we've actually made a very early investment. That gives us an opportunity to look at battery tech and so on. There is obviously global tailwinds which are also helping India in this, right? India always didn't always have a place in the global supply chain. As the world looks to actually diversify their supply chains, which is China plus one strategy, India is a logical destination, and our companies are able to take advantage of that. And we end up investing in some of these companies. Go ahead. Last on markets. I apologize for the formatting here, but this orange line gives you a sense of where India is, and India has outperformed all markets globally. The interesting thing in this bull run, next slide please. The interesting thing in this bull run is that this has been now driven by domestic capital. So if you look at this line and the line before, and you see that the markets are growing throughout, a lot of that is driven by foreign investors and foreign investors coming into the market. If you look at this, net till December 23, foreign investors sold 50 billion. But that was bought by Indian domestic institutional capital. And this is a very big deal, which means that as an India public market, it is now stable because it's essentially driven by India domestic capital. And that domestic capital essentially comes from systematic investment plans, which is like the 401k, which is every retail investor contributing to these domestic institutional funds in a small way. And of course, the payment infrastructure is driven by UPI and so on. So big deal that this is now a domestic driven market. Keep going. That's led to a market for IPOs. So now we have companies of scale, we have a public market of scale, and therefore we have companies that can go IPO. This was the biggest problem with the venture market. We had no IPOs till 2020. Then we started seeing a bunch of IPOs in 2021. And now we're seeing a consistent set of IPOs that are coming to market because it is possible to take these companies public. And this top line is a list of our companies. I think that, maybe like 2018, 19, I used to be asked by LPs, what are you going to do with these companies? And I remember signing a petition that went to the government of India in 2019 saying, please let us take our companies public on NASDAQ, because that's the only way that we are able to take these companies public. So I signed that petition. Thankfully, the government didn't listen at all, but they acted in a completely different way, which is to open public markets to these companies, and that's what has made this ecosystem completely possible. Keep going. How have these companies done after they go public? Almost all of these companies, you will see, have actually traded up since the IPO. So it's very stable aftermarket, save for one which has regulatory challenges. So these companies have done listed and then are growing in those public markets. Go ahead. All of these companies have actually worked on one thing, which is profitability. India is a much more profit-focused market, and you will see since they have listed, all of these companies have improved on profitability and therefore have grown into those valuations and surpassed those valuations. So it's both growth as well as profitability, which is actually driving those valuations. Keep going. I talked about strong aftermarket support. It's both domestic as well as foreign institutions which are providing that aftermarket support. Go ahead. I think what's happening is, if you take that first set of companies, they took 11 to 12 years to go to IPO. Now it's taking 7 to 8 years to go IPO. Ola Electric, it's taken them 6 years to go IPO. So the period to go to IPO scale and then list and become public is becoming shorter and shorter, which is a big opportunity both for us as well as LP investors coming in, because you can turn your capital that much faster. Keep going. I think I made this point, Skip. I think in conclusion, I'll go back to that one slide that Tarun said on the $2 to $3 trillion opportunity. There is the macro, which is helping us, which is India is ascending. In that, digital is super important. And then there is a startup ecosystem, which is ready to actually inflect and take advantage of all of the growth that India has to offer. So it is sort of the macro as well as the bottoms up in the venture ecosystem marrying together, which we think will make this picture possible. Thank you for the time. We're around and look forward to hearing from you as we network in the next session. Thanks.
I would now like to invite Mr. Siddharth Shah from Khaitan, a leading Indian law firm, to talk about the legal aspects of investing in private equity and venture capital funds in India.
Thank you everyone. I think for bearing with us on this afternoon till now. And first of all, I'd like to really thank and congratulate the embassy here for really giving us this opportunity, and His Excellency as well for kind of creating an opportunity for us to really present this India as an asset class. So I think obviously the previous speakers have really laid down in great detail, and I think in my own assessment, a very compelling case of why and what of India and why there should be a participation from Japan into India, and a compelling case was made there. And obviously my focus here would really be to try and focus more on how to access India, and obviously in a way try and demystify India, because we did see some of the risk factors being talked about regulations, changes, and also I think it's only apt for me as a lawyer to try and clarify some of these questions that you may have. And I think maybe in my own assessment, India is probably not as complicated as it is made out to be. And I think it has come a long way in its journey in terms of evolving itself as a stable regime for various asset class, and alternative being no exception. I think a few case in point, I mean today a lot was talked about how the Indian markets and then domestic capital has really come into the Indian markets. I think the story is no different when you look at alternative assets. So really, if you see the growth of Indian participation in alternative assets, I think it has seen the most significant growth in the last 10 years. I mean, today, the general perception, and maybe that it was true maybe about 5 years or 8 years back, almost about 70 to 80% or even 90% of the capital that was being invested in VC, private equity, or any of the alternate asset class was really coming from offshore. But if you really look at the numbers, and now these are well kind of sanitized numbers published by the Indian regulators, SEBI, I think that number is almost close to about 40%. Now, what does it mean, I think, as global investors? I think there is a matching Indian capital sharing the same confidence. So you are no longer, as a market, really looking at the offshore capital to really fund it. There's equal risk taking being shown by Indian investors and institutions. And I think that itself should drive a lot of comfort for people who are participating in the alternative asset class. So I really think it is the right time, and I think India is at its inflection point. I think nothing more to be said after the previous presentations. But what I'll also kind of walk you through is what has, even on why and what, driven from a regulatory perspective, so that you get to see and derive comfort as how India has evolved on that count. Next slide, please. I mean, I think a lot of the macros have been talked about, but I think from a lawyer or an advisor perspective, I think what has changed for India? I mean, first thing, if you really look at it, reduced cost of doing business in India. I think if you really look at the infrastructure from a physical infra to a business infrastructure, I think regulatory compliance, all of that, whether it is governance standard, whether it is laws, and I think it would be apt for me to mention, just last year, I think India repealed almost 1,500 laws which were kind of considered outdated. So it's really not about creating laws, but I think India has also realized that the complexity of the legal system can be a put-off. And I think the current government has really taken a strong initiative to try and modernize laws and really make them aligned more and more to what you see in the global world. So, I mean, you will also, as you see the alternative investment regime or even the tax regime, and I think I'll touch upon some of it, I think the ease of doing business or ease of investing in India has undergone a very significant change. Also, I think the forex reserve situation obviously gives added comfort. I don't need to dwell more into it. I think private investment push for infra, very clearly visible, I think through the presentations that we've seen, and service sector is obviously still the driving the economy. Maybe some of it will change with the manufacturing also now coming into play as well. Next slide, please. Yeah, I think I'll probably skip this. Can you take to the next slide? So I think I wanted to kind of take you through the timeline and then more from a regulatory perspective, largely as to why things have changed. So if you really look at it, one of the key change, 2001, and then the timeline is really from 2001 to 2023. So it's a 20-year kind of timeline. IBC, insolvency and bankruptcy. Laws in India were extremely complicated. I mean, restructuring businesses which have failed was almost an impossible task. Even liquidating businesses were difficult. India introduced the Insolvency and Bankruptcy Code, and if you really see the effect of it, even within our own asset class, I think credit as an asset class has really grown manyfold on the strength of the fact that there is a well laid out Insolvency and Bankruptcy Code. There are opportunities created for even PE investors to kind of go out, buy assets from non-performing loans or others which the banks may be putting out. So I think that has been a very significant driver and also a great contributor to inclusion of India into the MSCI index for bonds. Looking at obviously the opportunity on the investment, the market itself in sheer number of deals which are available. So I think that itself creates a compelling opportunity. Investment regime, and I'll touch upon some of them in more detail, but from a time when a lot of sectors were restricted, where you had to go back to the government for permissions, foreign investment was highly regulated in many of these, to a time today where you are actually allowed to invest in any sector, barring a very small list of negative sector where you may have either a restriction or a cap on participation. And those sectors are themselves, like a classic case would be a defense sector, which was always in a restricted sector. And in the last few years, we've seen that has been opened up for foreign participation. So I think it's been a very progressive approach, and I think we'll see a lot more of the liberalization as well. Also, I think for investors, it was always a question as lawyers we were asked, enforcing a contract in India. And I mean, the stories can be that while you may inherit your wealth from your seniors or not, but you will definitely inherit litigation. Now, I think that obviously created an adverse perception about enforceability of some of these contracts, especially as investors. And you look at the regime today, and I think whether you look at the Indian Arbitration Act, which has modernized itself. So while today you have the freedom to choose global or overseas arbitration for any contract that you do, you are also having a modernized Arbitration Act in India, which can also be as effective. So I think that some of these things, even the courts in their approach, have really become far more modern, far more sympathetic to fact and not giving leeway for counterparties to really use law as a workaround. And I think some of the examples like put options and an exit options for a PE investor was always whether these put options or exit rights are truly enforceable and whether we can actually manage to get a contracted kind of outcome. We've had n number of cases now, and courts have very clearly laid out the principle that one, as a party or as a counterparty, you cannot use law to really breach any contractual obligation, to the extent that one of the largest payout under an arbitration for a Japanese company, I think, proves the case. This was the Tata Docomo. So even exits with multi-billion-dollar payout was something which was upheld by the courts, and including the Reserve Bank as a regulator was forced to allow this remittance freely. So I think it's really a very, very different environment, even on diligence process. And I think as it was always an exercise which was relatively more tardy in terms of conducting diligence, forthcoming information was always a challenge. And you look at deals today in India in the same space, far more sophisticated. There's a lot more transparency in sharing of information, and even the sellers are far more sophisticated to recognize the need to disclose. Forensic audits, very common now, and then all of that obviously should add to the comfort that you are investing in an economy which has a far more matured legal system, which should protect your rights when it comes to investments. Yeah, I mean, I think same thing for indemnity obligations, again, the same thing. So I think definitely I'll think you probably need to break the notion if that exists. Next slide, please. So I think as you know, we still have what we call exchange controls, and I think maybe we are moving towards full convertibility, and then maybe a lot of it will change. But at the same time, when you are coming in as a foreign investor, you need to be able to choose a regime under which you want to participate. And there are more than one regime which may be available to you depending on your strategy. And as a foreign investor, you are allowed to use any one or all in combination depending on how you want to participate. The first one, which is obviously the FDI, which is the generic foreign investment regime, which is available for any non-resident. So you'd have no other eligibility kind of criteria or a registration requirement. As I mentioned, most sectors are available for up to 100% foreign ownership under what we call an automatic route. No need for prior approvals. All you do is really meet some of the conditions, which is largely around pricing, so that, and from, again, coming from the exchange control perspective, the idea is that as a foreign investor, you come in at a fair value, so you cannot come in at a value which is lower than the fair value, and when you exit, you really take out capital which is of fair value. Now, even on that, the government and the regulators given a lot of flexibility to choose your method. So you need to kind of certify through an accountant, but enough flexibility. And I can tell you the growth of private equity industry, even when they are a lot of them invested from overseas, we haven't seen that really becoming a challenge now, that if I'm exiting on an IPO or through a trade sale with a significant amount of capital being taken out, in most cases, you won't see a challenge in meeting some of these fair value requirements. So FDI is obviously that regime, and at the same time, it also allows you to do strategic investments into India. Also, the second one is what we call a foreign portfolio investor regime, which is really largely geared towards participating in public markets. I mean, you can obviously, we've seen some of the pipe transactions and strategies, depending on, you may do a pipe strategy using an FPI route or a hedge fund strategies. All of that can access Indian markets through the FPI route. That requires you to be licensed. Now, even there, the regime earlier required each of those applicants to go back to the SEBI, which is the regulator, to get a license. 2019 and onwards, I think all of these powers have been delegated to a custodian in India. So all you need to do is fulfill the KYC, and the custodian can issue you a license through which you can start participating into the Indian market. So I mean, from a timeline, if it used to take you about 3 months to get a license as an FPI or FII through a regulatory process, it's now a matter of 2 weeks or 3 weeks for you to fulfill the KYC, and you are free to trade on the Indian markets. So it's a significantly changed environment there. Again, FPI route allows you to do and participate in corporate debt in India, and that is where we've seen a lot of credit asset class evolve through FPI route. Again, a very attractive proposition for those who really look at credit. Obviously the enforceability combined with the opportunity to earn higher interest, I think definitely makes it a good case. Besides, also we've seen credit in the distress space. Again, large platforms by global PE and other players have been created to kind of participate in some of these opportunities. So definitely something which is available for all of you as well. There's also what we call a foreign venture capital investor regime, FVCI. Now, that regime is really carved out from the general regime of FDI for private equity and VC investors. Now, obviously, it's driven by policy thrust, so the benefit of FVCI is really exemption from any of the pricing restrictions that I talked about. So as an FVCI, you are freely allowed to price your entry and exit. You are able to enforce your rights on put option at a pre-agreed return, all of that, and also use optionally convertible instrument, all of that, but is limited to 10 sectors. And those sectors include some of the sectors that we talked about today, like infrastructure. So a lot of infrastructure investment can definitely benefit out of that. And the general rule of thumb for private equity VC investor is, to the extent that you can participate through the FVCI route, that should be your first preference. And then otherwise you always have the FDI route. So it's definitely, it does require a registration with SEBI, but again, not a very complicated process. I think what also, and when I talked about domestic LP base and participation in alternative assets have grown, it's also about AIFs, alternative investment funds in India. And that's not only available for domestic investors, it's equally an attractive proposition for global investors. Any form of foreign investment is freely permitted in onshore AIFs, where you can come in as an LP with no need for any prior approval. You can take your distribution out without any restriction, and from a tax perspective, such structures are considered to be pass-through. So you are effectively not losing any tax by coming in through AIFs. So that's really where a lot of domestic and offshore pool is also getting pooled through what we call the AIF structure, and we'll quickly show some of the structures as well. And the last one, I won't touch upon it, not relevant here, but it's really direct lending into India has also been simplified significantly. So a lot of global banks have also been taking benefit of that. Next slide, please. So, yeah, I mean, I think a lot of this has been covered as a part of my previous discussion. I think the only couple of points that I would highlight, and under FDI, as I talked about, the pricing, put options have been held to be enforceable now. The only requirement is there cannot be guaranteed returns, because from an Indian perspective, that guaranteed returns kind of moves away from equity into a debt zone, and hence somewhere you are allowed to enforce your put through a fair value, except if you have situations where you can enforce it through arbitration or any other thing, as the case I pointed out. I think that also has been held enforceable as well. And lastly, I think we are also seeing a significant growth on the REITs and InvITs. So they are providing an excellent platform for a lot of AIFs and offshore kind of private equity which have invested in these sectors as a very viable and a profitable exit. We have obviously now almost 11 InvITs and probably around 4 REITs from the likes of Blackstone and Brookfields of the world, who have obviously accumulated significant real asset on the ground and have also benefited out of the exit through these mechanisms. Next slide, please. I think we can probably skip this one in the interest of time. I mean, these are all just a few headlines, that more recent ones giving you a sense of kind of deals and size of the deals that we have seen. not at all comprehensive. Next one, please. I mean, these are some of the, we see both domestic and international players that you see them very actively engaged in the Indian market. Some of the funds which have been raised in India and India-focused funds, I'm sure we can, and then we've shared the PPT with you, so you can, next slide, please. And I think there are already some of the counterparts from here who are actively benefiting out of this growth story from Japan. And obviously the large global players, sovereign investors, I think all of them are obviously bulking up on India, as I would say, and I think that's really where the opportunity is also being created. Next slide, please. So I think coming to the structuring, I think obviously not as complicated as it is at times made out to be. I think, next slide, please. What are the key considerations when you are investing in India? And I think if you're investing as a fund or you're participating as an LP into a fund which is investing in India, some of the key considerations obviously would be, and which would have an impact on the structure that you choose. So one is there a domestic participation alongside the offshore? So depending on if it's a pure offshore kind of vehicles, then obviously you have a choice of doing it entirely from outside of India and come in through the FDI route, as we call it, as a pure offshore structure. Or if you are really looking at domestic pool, then obviously you have the AIF onshore for domestic investors. The choice being whether you create a unified structure with both the pools kind of coming into the AIF, or you run it as a two parallel structure. So choice is available to you, I think, under that. So, but the structure will get impacted depending on the capital source. The second is the choice of vehicle. And I think here again, unlike many other markets, you've seen that a preferred choice of vehicle when it comes to onshore vehicles. I mean, offshore, you always have a choice of choosing the more convenient LP or a corporate structure. But in India, I think typically you have seen trust as a more preferred structure for fund vehicles. And I think a large majority of AIFs are structured as trust. Some have also used what we call limited liability partnership structure. So, but trust obviously comes with most flexibility. It is a non-entity for tax purpose and for legal purpose as well. At the same time, it creates the fiduciary responsibility between the manager or a GP and the LPs. So I think in many ways you'll see trust as a more common structure, but more recently, as recent as yesterday, I think the budget announced an introduction of new vehicle called Variable Capital Company. I think many of you may have heard about it being very successful in markets like Singapore. And I think the Indian government also wants to bring in the same choice of vehicle for the investors in India. So you may soon see some variable capital company structures as well. Obviously, status of the management team, and I think this has more to do with the tax considerations. I mean, if you have team which is sitting on the ground, you need to assess what we call a permanent establishment or a place of effective management risk. I think not very different from many of the other markets where the revenue authorities would always be enthused about seeing whether the actual management is happening on the ground or actually happening offshore. So one needs to be careful, and some of the structures need to kind of take that into account. Also, I think I would say the double tax avoidance treaty, and I think I have a slide at the end where I think depending on, I think while capital gains, which was obviously the most preferred reason why people chose an intermediate jurisdiction like Mauritius or Singapore or any other markets, I think India has kind of renegotiated most of the treaties. So the long-term capital gains exemption or capital gains exemption in general have been done away with. So what it means is if you want to access India, I mean, yes, you will have a cost of investing and on capital gains. It's 10% today. I think the budget has proposed to raise it to 12.5%, but it doesn't now require you to add any complexity of going through an intermediate jurisdiction for investing in India. I mean, and then India-Japan itself has an excellent treaty, and I think to the extent that your local regulations allow you, you can directly participate into the opportunity and you'll be taxed at the same rate. So it kind of eliminates the hassle of creating intermediate structures as well. I think next slide, please. Yeah. I mean, this is a typical structure. I think for AIF, this is more when you're presented opportunities to participate into AIFs. This is where you will have an investment manager in India. You'll have an AIF, which will be regulated and registered with SEBI, which is the securities regulator. And as I said, trust is the real most common form. So you'll have a trustee. Yep. Next slide, please. I think I've touched upon it. Maybe I think if we can move to the next slide, which kind of gives you, I mean, this in summary is really the structure options that we've typically seen. You have obviously what we call a co-investment structure where offshore pool and onshore pool co-invest in opportunities together. Several of these you may see in the Indian market, especially global GPs who are now looking to tap into the Indian investor base. I think in their, to keep the two kind of structures isolated from a risk perspective, use a lot of co-investment structures. You also have now unified structures, largely used by Indian GPs, who are really looking at raising both domestic and offshore pool. I mean, it simplifies the management structure because you have a single manager and then the offshore fund becomes a feeder into the onshore AIF. So that's something which you will also hear or see a lot in India. And of course, you have the pure offshore structure, which has always been a traditional structure. Your jurisdictional choice will come to that quickly, but I think those are the different models that we have seen typically. You may see some complication of adding more feeders on it depending on the need of LPs, but I'll try to keep it as simple here. Next slide, please. So which are the offshore jurisdictions that we've seen? Next slide. And a very quick kind of compare, I think obviously traditionally we've seen, especially for Japanese investor, a strong preference, which honestly at times I've failed to kind of fully understand or comprehend why, but Cayman is probably the most popular pooling structure for investors. So Cayman obviously is one. Singapore and Mauritius traditionally because of the treaty were always very attractive and also jurisdictions which were quite familiar for people who were investing in India because of the treaty benefits which they offered. Some of it I think is no longer valid on capital gains. And then I'll talk lastly on GIFT, which is again a brand new international finance center, services center, which has been created on the ground, but has all the benefits of being an offshore jurisdiction. And we are seeing a very significant shift amongst the PE and VC investors as well, especially domestic GPs who are also looking at GIFT as an alternative to some of the other jurisdictions as well. I think again, I don't need to go through the tax rates under the treaty, but I think the highlight would be that if you are investing for long-term capital gains, in most cases you will end up paying tax in India. So you don't need an intermediate jurisdiction. If you are looking at other streams of income and then if it's interest, then maybe some of the jurisdictions may give you a lower withholding on interest, as shown on the slide here, including GIFT City in some structure will also grow. So I think you need to kind of weigh in terms of our strategy and the nature of income, and then obviously the choice of jurisdiction will depend on that. Next slide, please. I mean, these are something, some of the local considerations in these jurisdictions. So, I mean, I think obviously when choosing a jurisdiction, you also need to take into account that you are not only looking to optimize or minimize Indian taxes, you also don't want to be in a jurisdiction which itself has higher taxes. And I think which is something which is important here, but I think these are again for their own reasons more popular jurisdiction for fund location for investing into India. Next slide, please. So this, I think, we tried to summarize some of the tax rates which are available for Japanese investors who are kind of participating in India. The first one really talks about if you are doing it directly out of Japan, then under the India-Japan treaty. And as you can see, the rates are pretty attractive for you. So you, from a tax perspective, may not really have a reason to go through any other jurisdiction. Of course, commercially from a pooling, etc., I think you definitely can look at other options to that extent. I think if you are also participating directly into onshore AIFs, again, which, as I mentioned, can be a pass-through, then again, I think you will benefit out of the same treaty benefit because you should be able to avail some of the treaty benefits because the AIF is a pass-through. So as an LP into an onshore AIF, you will still have the benefit of the treaty. And lastly, I think which is more relevant for public market funds and especially hedge funds, which is the category 3 AIF under the domestic law. There, I think you do have benefits on certain types of income, especially your derivative income, which can be completely tax exempt if you are set up in GIFT City, for example. I think that is really why one of the reasons where we've seen a lot of quant and algo traders also kind of setting up base in GIFT City. So I'll come to that in a bit. Next slide, please. So GIFT City, I think just a snapshot of where it stands. I mean, it's a brand new international finance center conceptualized probably about 10 years back, 12 years back, but really the inflection point, and I think it's really a territory within India which has been deemed to be a foreign territory for all purposes. So the idea and the philosophy was that if Indian managers or asset managers or institutions had to go to a international finance center outside of India to really bring capital back into India, why not create a comparable kind of regime in India? And it also meant that while India still has capital controls, this jurisdiction had to be given the exemption from being subjected to any of that. Sorry. And I think it has its own regulator, which is a unified regulator. So unlike in India, when you see multiplicity of regulators governing different sectors, so you have RBI governing banks, SEBI governing securities market, or an insurance regulator governing insurance. In GIFT City, there is one single regulator, which is the International Financial Services Authority. And I think that kind of makes the ease of doing business in GIFT much more flexible and much more efficient. So I think a single regulator, anyone setting up operations in GIFT needs to be licensed. And if you see the way the growth has happened, I think it's already becoming a very, very popular jurisdiction, and especially also for a lot of the alternative assets. I mean, we are now close to about 130 funds, VC, private equity, and credit funds, which are already licensed and set up in GIFT, and that number is only going to grow significantly. So I think as you prepare for your India strategy, whether as a GP or an LP, I think you're bound to hear more about GIFT as well. Next slide, please. Next slide, I think you can skip this one. So these are just the snapshot of kind of entities. So GIFT is not only about asset management or banking and finance. I mean, they are also creating capacities. There are foreign universities which have also been allowed to set up operations in GIFT. So you probably will have Howards of the world and also several other universities who will be setting up their campuses in GIFT City to kind of offer programs for Indian students, and then obviously that's also going to create capacity for talented professionals in India. And then similarly, I think you also have the global in-house centers, again becoming very, very popular for the tax holiday that it offers. So GIFT, any entity set up in GIFT and is earning any business income is entitled to a tax break of 10 years in a block of 15 years. So you get a complete tax exemption, subject of course to an alternate minimum tax, which is about 9%, which is also creditable. So it becomes extremely interesting and profitable for some of these entities to operate business out of GIFT, and which is why what is also a big incentive which is triggering the shift out there. Next slide, please. Yeah, I think I will probably leave this for you to kind of audience, and we are around to kind of answer any questions that you may have, but very clearly very favorable tax regime which has been offered. Next slide. Okay, I think that's pretty much it. And just a bit about the firm. I think obviously Khaitan is one of the oldest firm, 113 years young as we call it. We are also probably one of the largest firm with 1100 plus lawyers, 250 partners, full service platform. We also have a very active Japan desk, and we've been covering Japan for more than a decade now, and we also work with a lot of institutions here. So if there are any questions or otherwise, I mean, do feel free to reach out to us. Thank you so much for your patience. Thank you.
Thank you, Siddharth. So that marks the end of the proceedings for the evening. Thank you so much for your time. We hope you learned a little bit more about private equity and venture capital in India and the opportunities it affords. And now we have a brief networking and mixer session outside. So we'll see you in the foyer. Thank you so much.